Let's be honest. 2025 didn't feel normal. It felt like the entire market was daring itself to break. And somehow didn't. On one side, you had people screaming recession is coming. On the other side, investors were piling into AI stocks like it was the last seat on a rocket before liftoff. And somehow, both sides stayed alive. Unemployment stayed low, consumers kept spending like the bill would never arrive. And if you tried shorting Nvidia at any point during the year, you probably aged faster than the stock recovered. It was messy, confusing, hard to read from any angle. And now we're in 2026. And instead of things getting clearer, they got more complicated. Rate cuts are still on the table. AI hype is running as hot as ever. Some people are calling for a soft landing. Others are bracing for a hard one. A few think nothing breaks at all, and this thing just keeps going. So what actually happens next? Because this year could go two very different ways. This could be the year markets explode higher, or it could be the year you look back and quietly wish you'd kept things simple and stayed safe. After getting the same question flooding in over and over, what do you think happens in 2026? I figured it made more sense to just lay it all out in one place. No pretending to know the future, no picking a side just to sound confident. Just the real possibilities as I actually see them. So here's how I'm thinking about it: the bear case, the bull case, and the scenario that almost nobody is preparing for, which I think is the most dangerous one to ignore. And since things usually get worse before they get better, let's start with the downside. We can't talk about 2026 without talking about AI. Whether you believe it's genuinely reshaping the global economy, or you think it's an overhyped wave that's going to crash back down, there's one thing you can't ignore right now. The prices don't match reality. Not even close. Some of the biggest AI-related stocks are trading at multiples that leave absolutely no room for error. Nvidia sits at around 47 times earnings. Palantir is somewhere around 400 times earnings. Datadog is pushing past 430. At those numbers, people aren't buying what these companies earn today. They're buying what they hope these companies become 5 or 10 years from now. That's not investing on fundamentals. That's placing a very expensive bet on a future that hasn't shown up yet. And here's where it gets dangerous for the broader market. It's not just those individual stocks that carry the risk. They're dragging the entire market up with them. When Nvidia moves, semiconductors move. When semiconductors move, the broader tech sector moves. When tech moves, the S&P moves. So now you've got an entire index being lifted by a small group of companies all riding the same story. And when you zoom out, the S&P 500 itself is trading at nearly 31 times earnings, roughly double its long-term historical average of around 16. Markets don't stay stretched like that forever. At some point, things snap back. Not always because of some dramatic external event, but sometimes simply because they went too far and the rubber band had to contract. Now, layer on top of that a problem most people aren't paying enough attention to: how concentrated this market actually is. The S&P 500 is supposed to represent broad diversification across 500 companies and multiple industries. That's the whole pitch behind index investing. But the reality right now is that a handful of giant tech companies, the Magnificent Seven, represent over 35% of the entire index's market cap. Through the first 3 quarters of 2025, those 7 companies accounted for over 41% of the index's total returns. If you swap one name for Broadcom, that contribution jumps past 55%. So when someone tells you they have a diversified portfolio through an S&P 500 index fund, what they really have is a portfolio where more than half the performance is coming from 7 companies. That's not diversification. That's concentration dressed up in index fund clothing. And passive investing is quietly making this worse. Index funds and ETFs are market cap weighted, which means the bigger a company gets, the more automatic money flows into it every time someone buys the fund. So as these tech stocks grow, they pull in more capital, which pushes prices higher, which makes them an even bigger share of the index, which pulls in even more capital. It's a beautiful feedback loop on the way up. On the way down, that same loop works in reverse, and small declines become amplified very quickly. Now, take all of that and add one more layer. Statistically, we're overdue for a reset. Markets move in cycles. They always have. Since 1954, the S&P has seen a meaningful pullback of at least 10%, roughly once every 3 years. We've had a strong extended run, and history consistently tells us that outsized returns in one period get balanced out eventually. That's not a crash prediction. It's just math and cycles doing what math and cycles always do. But here's the trap that makes the bear case genuinely dangerous to act on aggressively. You can see every one of these problems clearly: the valuation stretch, the concentration risk, the overdue correction, and still lose money betting against it. Because timing matters more than being right. John Maynard Keynes said it about 100 years ago, and it's still just as true today. Markets can remain irrational longer than you can remain solvent. Markets don't fall just because they should. They fall when something forces them to. And until that catalyst shows up, things can stay expensive and illogical for a lot longer than logic would suggest. Which brings us to the bull case. Because what if none of that matters right now? What if markets just keep pushing higher regardless? There are two real reasons why that's entirely possible. The first is interest, rates. This one is genuinely significant, and it changes the whole picture. Lower rates make borrowing cheaper for businesses. They make future earnings more valuable in today's dollars. They push investors who need returns away from safe assets like treasuries and toward risk assets like equities. And they loosen financial conditions across the board in ways that support higher valuations, even when the underlying economic data feels mixed. The Fed delivered 3 consecutive 25 basis point cuts to close out 2025, and the expectation going into 2026 is at least one more. That direction of travel, rates heading lower, is a real structural support for asset prices that's hard to dismiss. The second reason is government spending, and this one doesn't get nearly enough attention in these conversations. The United States is running a federal deficit north of $1 trillion annually. I've talked on this channel before about the long-term damage that trajectory is building toward the compounding debt, the growing interest burden, the eventual reckoning that nobody in Washington seems particularly eager to address. All of that is real. But in the short term, government spending is stimulus. It puts money directly into the system. It supports consumer demand, props up corporate revenues, and keeps economic activity higher than the underlying fundamentals might otherwise justify. And unlike monetary policy, which can pivot in a single meeting, fiscal policy moves slowly. Programs take years to build and years to dismantle. Budgets don't get slashed overnight. Politicians don't win elections by campaigning on spending cuts that hurt the people they need to vote for them. So even if economic growth softens, the fiscal backdrop continues providing support on a slow, persistent, politically guaranteed basis. Lower rates and sustained government spending together create a floor under risk assets that the pure bear case consistently underestimates. That's how markets can keep grinding higher through 2026, even when everything on a valuation basis looks uncomfortable. The bull case has real substance. Dismissing it because stocks look expensive has cost a lot of people a lot of money over the last 3 years. But here's where I want to spend the most time, because I've laid out the bear case and the bull case, and both of them are well covered. Both have smart people arguing for them loudly. Both get plenty of attention. But there's a third scenario that I think is more likely than either of them, and it's the one that quietly destroys the most portfolios without anyone ever feeling the moment it happened. Not a crash, not a melt-up. Something right in the middle. A long, choppy sideways year where the market moves constantly but goes nowhere meaningful. Picture what a year like that actually feels like from the inside. January opened strong. Rate cut expectations are intact. AI headlines are positive. The market rallies 4% in 3 weeks, and everyone starts updating their year-end targets higher. Then, February brings hotter than expected economic data. Rate cut expectations get pushed back. The market gives back half those gains. Bears declare vindication. March brings an AI earnings disappointment, and the sector sells off. April brings softer inflation data, and rate cut optimism returns. New all-time highs. Bulls declare the bear thesis dead. And that whole cycle, rally, fade, sell-off, bounce, new high, sell-off, just keeps repeating through the year. December arrives and you look at the chart. The index is roughly where it started, maybe slightly higher. On paper, it looks like a quiet, boring year. But look at what happened to every investor living inside that market. The thing about an actual crash is that it's brutal, and it's fast, and it's legible. When the market drops 35%, you know what's happening. You hold or you sell. The situation is clear. A choppy sideways market does its damage completely, differently, and far more slowly. Every rally in this environment feels like the start of the next leg higher, so you buy in. Then it fades. You tell yourself to be patient. Then it drops further. You question your thesis. You sell to protect what's left. Then it recovers above where you sold. Now you've locked in a loss and missed the bounce. That cycle breaks people psychologically, not because they're bad investors, but because that kind of price action is specifically designed by the collective behavior of millions of participants to trigger exactly those decisions at exactly the wrong moments. The momentum traders get chopped up buying breakouts that immediately reverse. The value investors deploy capital at what looks like a dip and watch it drift lower. The defensive investors who moved to cash during the volatility spend the rest of the year trying to figure out when to get back in, usually at exactly the wrong time. And on top of all of that, capital doesn't sit still in a market like this. It rotates constantly. When tech sells off, money moves into value. When value underperforms, it rotates into energy. When energy spikes, it rotates back into growth. Something is always going up, which means there's always a narrative for why you're in the wrong thing. Whatever you own, something else is doing better. And the investors who chase that rotation get steadily destroyed by transaction costs, tax events, and the inevitable lag between when a sector starts leading and when it becomes obvious enough to act on. This is the market environment I think is most likely in 2026. Not because I have a crystal ball, but because the setup. Real structural risks that haven't resolved. Real structural supports that haven't faded. A Fed in a genuinely difficult spot on inflation and an economy that keeps sending mixed signals is exactly the kind of environment that produces confusion rather than trend. And the honest truth underneath all of this is that nobody actually knows what happens next. Not the loudest voices online. Not the institutional analysts with their year-end price targets. Not the people with the cleanest charts. Everyone is working with probabilities. Nobody is working with certainty. The difference between the people who do well in a year like this and the people who don't usually isn't who made the right macro call. It's who built a portfolio they didn't have to react to emotionally every 2 weeks. So wherever you land on all of this, whether you think 2026 is the year things finally break, the year the bulls keep running, or the slow, painful, grinding middle that frustrates everyone, the strategy matters more than the prediction. It always does. Drop your actual read in the comments, not the safe answer, the real one. I want to see where this audience actually stands. I'll see you in the next one.